Hi guys, it's Geekonomics here and welcome back. Slightly different venue as you can see for today's video. No whiteboard in the background and so on. And today I want to talk to you, this will be quite a lengthy video I think, but nonetheless I think it'll be useful to you. So I'm going to talk about financial markets, and in the next series of videos I'm going to talk about various aspects of financial markets. Been looking at this in quite a lot of detail with my own students recently. Hasn't appeared, as you well know, I'm sure, on the A-level specification in terms of an essay or even a smaller question. So what's the likelihood that it'll appear this year? Probably that much higher than it has been in previous years. So before we get started, let me just recommend to you this book by Mervyn King, which many of my students have purchased and been watching in recent times. And it's a great little book from the point of view of getting together a whole host of quotes which you could use to add into a conclusion of an essay, particularly on financial markets. Obviously it's a great read, but from the point of view of your studies of financial markets, I commend that one to you, particularly obviously of relevance to the financial crash. So today what I wish to talk to you about, and I apologise in advance for the sort of length that we're going to go on here, but I've been looking at financial markets recently with my own students, and particularly we've been looking at whether or not bank bailouts are appropriate to prevent the economy from experiencing what we refer to as systemic risk. And so I want to go through with you what could perhaps ultimately be, I suppose, the components of an answer to an essay question on this, and if you assimilate this into some sort of reasonable order and learn it, there's every possibility that in the exam you could possibly regurgitate this for part or complete of an answer. Okay, so let me just start off, and I'm going to talk about the levels obviously as we go through this. So level one, we're talking here about definitions. And so I just want to throw a few definitions out there to you. So systemic risk and what we mean by systemic risk. I'll give you a few quotes and so on later and reference where I've acquired various things from. But systemic risk is the possibility that an event at the microeconomic level of an individual bank and or insurance company could trigger instability or collapse in an entire industry or economy. So it's this notion of something happening on relatively small scale, the microeconomy, then becoming much, much bigger and affecting the macro economy, the economy or the industry as a whole. What do we mean by contagion? So contagion is the interconnected financial world, and of course as a consequence of that it means that shocks in one location impact on the rest of the world. And we saw that in the 2008 financial crash, when the subprime US mortgage market collapsed and we had the problems initially in Fannie Mae and Freddie Mac, those American US banks, and of course then because of the connectivity of financial markets, that then spread to the UK. So it's that interconnectedness which causes the contagion. And then finally, by a bailout we mean the government stepping in to obviously rescue a failing bank, rather than just let said failing bank collapse, and we'll talk about whether or not that might be more appropriate in certain instances. So those are our basic definitions. So now we want to look at a little bit more detail. We want to talk maybe a little bit about application here, and to just say, well, how do bank bailouts work and why might they be appropriate or not appropriate? So bank bailouts may be necessary for the prevention of systemic risk. And of course, Mervyn King says in his book, this is a great quote from his book, he said that banks were too big to fail, too big to sail, and too big to jail. So in terms of their size, they were enormous. That size, that sheer scale, made them very difficult then to pilot and to navigate, and ultimately therefore it was very difficult to nail people and to jail them, because it was very difficult to isolate one individual because everybody was up to the same old tricks, and we'll talk about what those tricks were later. And banks may need to be bailed out for three reasons, really. Three reasons that we could cite. So number one, they're unable to regulate themselves. I think we've seen that it's not possible. Greed, herd mentality, whatever you wish to call it, means that banks find it difficult, and bankers find it difficult to regulate themselves. Number two, bankers particularly tend to be motivated very much by short-term gain, making huge money and profit and reward for themselves and not looking into the future, and as a consequence of that they then take excessive risks. And that's the third point, is the fact that they take excessive risks and they don't bear the consequences of those excessive risks because the bank is being bailed out. And of course, if you keep bailing people out when they do something which is wrong, then there is no nudge in their behaviour. There's no Richard Thaler, nudge theory. There's no nudge for them to amend their ways, change their behaviour, and as you know in economics we call that the problem of moral hazard. And I think as you go through this financial market unit and various components of it, you'll see that the whole notion of moral hazard is prevalent throughout the sort of reading that you would do on this topic. So that's level 1 and level 2, knowledge, applications. Then what about a little bit more, what about analysis here? And why it might be good to bail out a bank, why it not be good to bail out a bank. So number 1, why is it good to bail out a bank? Well, it obviously reduces contagion. High street banks, they borrow and lend from one another, don't they? All times of the day, every day of the year. And therefore there is that risk of contagion across banks, be that locally, nationally or internationally. And therefore, number 1, bank bailouts reduce that risk across banks. As I was doing a little bit of reading around this, I came across a few papers. One of them is by a guy called Alan Berger, and he provided a very useful and helpful quote, and he says this, that bank bailouts provide a cushion to absorb losses. I suppose in a similar way, if you think about counter-cyclical capital buffers, a similar sort of notion there, but it's a nice little quote, isn't it? A cushion to absorb losses. And then thirdly, the American economist Hyman Minsky, again this is a great quote, which helps us I think to understand the 2008 crisis. He says this, market economies inevitably exhibit financial instability. They follow a path of prolonged stability which generates excessive confidence and ultimately drives bubbles and risks. And what he's saying here is that it's therefore inevitable that eventually the bubble will burst and the banks will need bailing out. It's a great point. And if you think of the 2008 financial crash, that really it's what happened, isn't it? The bubbles emerged, they then burst, and then the banks were bailed out, exactly as he said, really. However, on the other hand, what about problems associated with bank bailouts? Well, there is the argument that when you keep bailing banks out, actually it's going to lead to, in the long run, greater systemic risk, because if banks realise that they will be bailed out after mistakes arise, then they've no incentive to change their behaviour, therefore they keep taking risks, and indeed maybe keep taking bigger and bigger and bigger risks, and therefore the extent to which they need bailing out grows and grows and grows. And then a third point would be that bank bailouts provide no nudge for firms or banks or bankers to change their behaviour. And what does this lead to? It leads to a vicious cycle for the banks. They've no nudge. And Andy Haldane, whose name may be familiar to you, familiar to many I'm sure, formerly Bank of England, and he said this interestingly, which is sort of in contrast to what Mervyn King says in his book. He said that individual banks, number 1, they should fail, and he makes this point. He said that the chain is only as strong as its weakest link, and so obviously if you have a weak link within the banking system, inevitably in an interconnected world, when that chain breaks, then not only does it affect that bank, but it affects other banks who are connected in some way to that. Another point, again, this is why bailout should maybe not be introduced, is of course because this places an indebtedness upon taxpayers for actions which are primarily out of their control in most cases. They're not the people telling the bankers to take excessive risks, yet they are the ones who lose out. And indeed, if you think, for example, back to the financial crash, when banks had to be bailed out and brought in from the private sector, as it were, well, immediately the shares in those banks, which were worth substantial amounts of money, which people had invested substantial amounts of their pension fund into, overnight and instantaneously, their pension pot values just went through the floor. And again, there's an equity, and also a responsibility there that shouldn't be allowed to be the case. And if I refer back to a couple of quotes again from Alan Berger, he said that bailouts may act as a signal that future bailouts are more likely. And of course that's not the signal that you want to be taking. He also said that this is an interesting point, there may be a stigma associated with bailed out banks which may reduce the demand for credit from them. So that's an interesting point. So banks which are bailed out, maybe in the longer term, they do suffer a certain amount of stigma and people are reluctant to put their money with them and to invest with them, and therefore the likelihood of there being demand for excessive amounts of credit from such banks is maybe limited. So perhaps in that respect that's a good thing. Berger also talks about the herd mentality, which you'll obviously be familiar with, and the fact that when one bank sees another bank making excessive profit by taking excessive risk, then they follow the herd. There's that herd mentality in that respect. And then I guess a final very interesting point here is to say, well, what would have happened, what to do. What would have happened if the banks hadn't been bailed out? Well, we can't say, and it's that counterfactual that we can't go back in time to the late noughties and say, okay, we're not going to bail out the banks and then see what happens. So we can, this counterfactual is an interesting point. The banks were bailed out, and that's the empirical data that we have to go on. Now, those of you who've been studying this, I'm sure you'll have been pointed to the experiences in Iceland. And what happened there was that the banks, or three of the biggest banks anyway, they ran up debts which were sort of 10 times the size of Iceland's GDP. And whereas in the UK, and Sir Mervyn saying that the banks were too big to fail, well, the Icelandic authorities said, well, the banks they've just got too much debt, it's impossible for us to bail out, let them fail. Now, as a consequence of that resulted in closures, job losses, currency devaluation, but I guess more importantly, an amending of behaviour, and also, I've never been to Iceland, so I'm just quoting from reading that I've done, but also quite a sea change in the structure of the Icelandic economy, in that people who had been employed in those sectors found that they had to take wage cuts, they had to maybe retrain, they had to seek employment in other sectors of the economy, and so structurally it's led to quite a fundamental change within the economy also. So there was that sort of changing attitudes and the restructuring of the economy, which is an interesting point to consider, what would have happened in the UK if the banks hadn't been bailed out. So in terms of a conclusion here, number one, bank bailouts are certainly, they're stabilising, but maybe they're only really useful for the worst, the real appalling culprits, those who do take enormous excessive risks and who will perhaps be more willing to respond to that behavioural nudge. It also, of course, allows good firms to survive and good banks to survive, Perhaps it should be the case that you just let the toxic banks fail and maybe let everyone else remain. That's a possibility. Or perhaps consolidations and mergers should be enforced. So if you could get some of the good banks to merge with the more toxic banks and to sort of spread that risk across a greater asset base, maybe that might be a way to go. Or perhaps another way to go would be that banks should be taking out some sort of insurance scheme. The same way as you and I would take out car insurance, so that if there was an accident, then there's a payout. Well, if there was an accident, so-called, in the financial market, then it would be the insurance market covering it, rather than the taxpayer and future generations in that respect. And just to finish, we've also been considering some of the alternatives to bailing out banks. So number one is, as we've touched on, well, just let the banks fail. Number two, allow the good banks to remain and maybe transfer the toxic assets to the government, so to strip out all that toxicity out of the financial market system. Number three might be to force consolidations and hence merge the good with the strong, the weak with the strong. And finally, in terms of an alternative, would again to sort of go back and to consider this whole notion of problem assets, as it were, and to try and come up with some sort of insurance scheme or policy whereby there was some type of fallback position if things went horrendously wrong. Anyway, ladies and gents, we're going to leave it at that. I hope that's been of some use for you. I do think that there will be a question, on financial markets this year. There hasn't been one yet. The more time passes through this specification without a question on financial markets, the more likely it becomes. So I hope you've enjoyed this video, and I'll see you again next time. Bye for now.